Hello, everyone. We are exploring two groundbreaking papers today in global finance. Our two authors have already presented their key findings to you, and we're going to dive in further. Professor Vidhan Goyal, whose work on index inclusion and corporate financing shows how entering a benchmark can transform a firm's capital structure in unexpected ways. And Professor Dong Lo, whose research on unintended consequences of holding dollar assets reveals the hidden liquidity trap facing global major institutions here. Both professors, as you may already know, are highly regarded in academia globally, extensively publishing in top finance journals. And they also have a track record in top advisory roles for central banks, global corporate strategy, and government policy making. Very exciting today. Together with our professors, two of our distinguished DBA alumni will be joining our panel discussion, giving us a unique opportunity to cross-examine theory and practice. Dr. Paul O, sitting to my right, CIO of FWD Insurance, and Dr. Joseph Cheung, CEO of Oasis Investment, and myself, David So, Head of Research and Portfolio Management at RBC. So let's dive in. My first question goes to Professor Goyal. Your research identifies a fascinating spotlight effect, where being added to an equity index fundamentally changes a firm's capital structure. But why is it, in simple terms, why is it that the surge in visibility, more analyst coverage, more news, I think 15% or so that you're pointing out, even measuring, serves as a massive tailwind for not equities, but bondholders and public debt issuance, leaving equity price informativeness and the cost of equity virtually unchanged?
So, that's a great question, and this is something we struggled with for years to try to explain in our paper, because our intuition would be that when a stock is added to an equity index, firms should issue more equity, or at least there should be some effect on cost of capital of equity. But we don't find anything. We looked really hard to sort of look for that effect, and there was no effect on the equity side. So what we are sort of arguing is that there is a greater amount of visibility and attention on the stock itself, but at the same time, there's also a massive surge in these index investors who are not responsive to information, who track the stock, who just hold the benchmark weight in their portfolio, and they are not incorporating information into prices. So they're not trading on information, they're not collecting information. They're just mechanically responding to index weight changes. And as a result of it, there is an offsetting effect that these passive ownership is reducing the informativeness in stock prices. And it's possible that the two effects, I guess, offset each other. So on the one hand, there is more information being produced, and this could be an active, endogenous response of other active investors, hedge funds, who want to produce more information on these stocks in response to a reduction in informativeness because of the influx of passive investors. So as a result of it, we found no effect on cost of equity. There was no change in cost of equity of these companies. There was no change in liquidity of stocks. So we looked at various measures of how liquid these stocks are. There was no change in liquidity as well. And there's no issuance activity on the side of firms. Firms are not issuing more equity as a result of it. But on the debt market, there is no offsetting passive ownership. Debt investors just benefit from these information spillovers as the stocks become, as there is more media coverage, more analyst attention to these stocks. There's the credit rating agencies also find it easier to update these ratings more often. We find more of these firms obtain ratings once they become part of the index. So all of the effects are on the debt side, and the yield spreads declines significantly. Only for the public debt where the information problems are more severe, not for the bank debt. So firms issue more public debt as a consequence of being part of the index. So these are interesting findings, and I think we puzzled over it for a while, but then we could explain it in the end.
I think it's really interesting because essentially we're taking an equity event and it's becoming a credit signal, yes, right? Which is where it becomes, very interesting.
Right.
The other interesting thing from your paper I found was the contrast across maybe US markets that are more efficient, and maybe here, Hong Kong, China, the impact could be somewhat different. So maybe a little bit on that, please, as well.
Yeah, okay. So you would expect, if it's an information event, you would expect the effects to be larger in environments where information problems are more severe. So when in environments where information frictions are greater, disclosures are weak, firms are not producing as much information, index inclusion will have a larger effect on visibility of the stock, and therefore the effect on leverage would be greater. And that's exactly what we find. So it's not so much about the geography, it's about the environment, the information environment. So US being more transparent, we find no effects in the US from index inclusions that we looked at. But in other countries, more developed markets where information problems are more severe, we find bigger effects of index inclusion on leverage. So if you think Asian markets, if many of the Asian markets have more severe information frictions, you would expect to see bigger effects from index inclusion on how much debt they can issue and how levered they become. Yeah.
I want to invite practitioner Dr. Joseph Cheung to this discussion. So you are a seasoned multi-asset investor, and I want to get your perspective on this asymmetry in equity and debt pricing that emerges after equity inclusion. Is this unexpected? Is this unexpected and not as well known, understood by the market?
I would have thought it's totally unexpected. The consequence, the result of the research is totally counterintuitive for the practitioners. Come to think about it, once a stock is included into an index, as a practitioner, our natural inclination will feel that, the influx of funds into the passive investors flow into the company, company buy the stocks, and the price will come, because of this, the price will go up, the cost of capital will come down. And the natural consequence, because according to traditional equity market timing theory by Baker and Werkler, I think, is that they will issue equity because the equity becomes overpriced. But the Professor Garrell's paper suggests otherwise. Actually, the dominant effect is the information spillover effect. In other words, there are more analyst coverage, 15% more in analyst coverage, 16% more media coverage, resulting in 15 basis point reduction in credit yield. And this is dominant effect. This dominates over the overpricing effect. Also, as I discussed with Professor during tea break, is that because although the indexation may not have as profound as effect as we imagine, because some anticipate the inclusion in the index, and therefore they may sell when the stock becomes part of the index. And that is why the result is very, very interesting. And also we also highlight something we call American exceptionalism, because that does not happen in America, because they have a very strong disclosure standards and high visibility, and that's why they're not as affected as in other jurisdictions. So it's a very interesting finding indeed.
Can I also chime in here? As a credit and fixed income practitioner, your paper suggests that investors do not look at the basics of credit when it comes to pricing. Once the company is being included in an index, right? Because the savings of 15 basis points in funding cost is on the back of increased leverage, right? Everything else being constant, right? So the credit fundamentals of the company, of a given company, may actually be worse than before. Yet, investors are willing to chase for additional supply of debt issuance because of the fact that the company is being included in an index. Yeah. Is that a fair statement?
I mean, it is. It is a fair statement. So the effects are, they're hugely important for the debt investors, primarily because of the rating effect. The fact that these firms are more likely to be rated once they're part of the index, and that's something I think that needs to be explored. as to why rating agencies are more likely to rate the bonds of firms that are part of the index. It could reflect greater demand from bondholders, and which is why, or the issuers themselves. We also find that the ratings are being updated more often, so they more frequently update ratings of firms that become part of the index compared to before. In fact, we talked to some practitioners who suggested that they would only buy bonds of firms that are in the index. There is some certification as well, right? So when bond investors are looking at bonds to buy, they're looking at whether the firm is part of the index or not. And that's also something that needs to be explored further in research, right?
That's to check the box, right? Just to ensure that when people ask, this is a company that is sufficient and well-known enough to be part of an index.
Right.
Hence, the PM is not buying any kind of credit out there in the market.
Yeah. So it could be that, right? Yeah.
I want to broaden our scope of discussion here. Professor Loh, your paper also talks about unintended outcomes, right?
If I may just add on.
Yes, please.
Add one more thing to this one. I'm not sure it works. Yeah, it does. So, there's a very interesting recent paper. I think it was Wei Shangjing has a paper on how S&P. So S&P index was one of the kind of most reputable indices in the world. And it turns out it's a very controversial paper too. S&P, I think, threatened to sue Columbia for publicizing that paper. So the key finding of the paper, I think, related to what you're saying, is the way S&P picks firms, because S&P 500 is a black box. Nobody knows how they select their firms, how they select the index components. So it turns out if you look at the firms that they rate on the bond market versus the firms that they include in their indices, there's a very strong correlation. So if you don't buy S&P rating services, the chance of you being included in the index is significantly lower.
There's supposed to be a wall, right?
They're exactly.
Businesses.
So I think the cool part of the paper is just to show that the wall, the wall that was supposed to be there, is actually getting more fragile over time. And I think I'm not sure how that's going to affect the results.
Wall is a glass wall. You can actually see through.
That's a Trump wall. It's American wall.
So that's why, let me add that, that's why we look at new index launches. We don't look at changes to S&P 500 because we don't really know how they pick firms. We look at new index launches, and primarily we can also see the rule that they are using. So the mechanical rule that they use to include the firm or not include the firm. So we can compare around the threshold. We can, let's say this index has 50 stocks. So we can compare the 49th stock with the 51st stock. So, they are similar in all respects. But one was lucky to be included. The other was not lucky to be included. They just missed, right? So we can compare those two stocks and say something.
May I also add something? As a practitioner, you want to make some money, it's actually, you should go for the bond market. So, because there will be reduction in yield spread over time. Also, not in US, in non-US jurisdictions, you may find some value before the index inclusion.
This is all very interesting. I do also want to get to your paper, Professor Loh. I mean, I have to look at these numbers again because it was so mind-blowing. This is a postmortem of March 2020 when markets moved really big. We were all probably busy with COVID back then, but then there was bigger, maybe arguably bigger actions happening in the market when $5 billion worth of forced selling happened in 7 trading days, I think it was. Very short amount of time. And this also in the safest domestic asset like UK gilts, and how this is actually predictable as well if you were to understand the mechanics of it. So I want to get your thoughts on this, right? This kind of volatility that we saw in safe government bonds during a crisis, and how this is really not related to fundamentals. Like investors might study fundamentals here, but this is more to do with, the technical plumbings of the FX market, industry conventions like margin calls, and also the strictness of, how these are settled under cash and so on. Can you tell us, what inspired you to look at this? What's the practical thing we need to take away here? Particularly, I really enjoyed how you work very closely with policymakers. What do you go back to and tell them to actually make a difference in making the system more reliable in that way?
Right. So, now first off, I think it's interesting to work with policymakers because they often, they have different perspectives from our perspectives. We're thinking about kind of the fundamental economic forces, and they have to deal with the daily the daily volatility, the daily liquidity of the market. Now, I think during, I'm sure well, many of you will know this. So in the last few years, there had been a number of crises in the U.S. Treasury market, and COVID was just one of them. You see Treasury yield spikes, I think at least 3-4 times in the last 5-6 years. A lot of people start thinking about the plumbing of the U.S. financial market. Is it as sound, as sophisticated as we thought it was? There are many interesting things happening there, and it turns out. So if I may, kind of broaden my my view here. So when I started working on asset pricing research, that was 20 years ago. We were thinking primarily about risk, about investor expectation, this sort of things, right? Now, I'm not saying risk is not important. Risk is still very important, but that's mostly for kind of the long run pricing. If you look at returns or price movements over months, years, or even decades, I think risk is the main thing that explains risk premium, explains expected return. Now, if you look at returns or price movements on a daily basis or weekly basis, I think what matters more is the market frictions and a lot of the institutional constraints. And in this paper, we're essentially looking at I think two important institutional frictions are features. Right, number one is that in the last 15 years there's a massive increase in USD holdings by non-US investors, and this is particularly salient after the global financial crisis. And it's kind of, a lot of things are counterintuitive, right? Because the global financial crisis started in the United States, and you would think people kind of learn the lesson and say, look, we got to diversify. But actually, more foreign investors put their money into U.S. dollar assets, and it's almost like in 1972, right? Nixon announced that the U.S. is going to pull out of the Bretton Woods agreement, right? Dollar was no longer going to be pegged to gold, and a lot of economists predicted the end of kind of the dollar system, but turned out the dollar system became even more robust, even more attractive. Now, we could spend a lot of time thinking about why that happened, but that's the first, I think, very interesting fact. There's a massive increase, and of course, with that, we saw a massive increase in hedging positions, which is very natural. Now, the second, I think, interesting institutional feature was the enactment of the leverage ratio rule, right? So before the global financial crisis, we have the risk-weighted capital regulation for banks, and then after the global financial crisis, especially with Basel III, we now have the leverage ratio rule. So things are weighted equally, whether it's repo or equity, which it sounds like a very bizarre regulation, but it was designed kind of to get rid of any discretion, right? It was designed for a good purpose, but then it turns out it has long-lasting impact on the entire financial system. And here, because of that regulation, because of the leverage ratio rule, broker-dealers were no longer willing to accept non-cash collateral for their derivative positions. So a lot of those insurance companies and pension funds had to liquidate their holdings on a short notice, right? Because they can no longer use gilts as collateral, so they have to convert gilts into cash. So a lot of those institutional frictions and constraints are becoming increasingly important to financial market patterns and regularities. I think a lot of so if you talk to, I think of myself as a kind of economist, financial economist from the previous generation. If you look at the current generation, more and more of the younger financial economists are looking at institutional details, looking at the plumbings of the financial market, looking at constraints and frictions, and try to understand how those constraints, seemingly benign constraints and frictions, can have significant impact on asset prices, significant impact on the stability of financial markets.
Wow. Well, it's like a tail wagging the dog kind of a situation, and fundamentals versus that part.
Yeah, and that's why I want to use the word, I want to emphasize the word unintended consequences. Right? When these rules are designed, they're designed for good purposes, right? I think they're carefully crafted. But then once you put those rules in place, there's just so many smart people in the market. Everybody tried to get around those rules, and that creates a lot of funny behavior, funny patterns. And we need more research trying to understand those the unintended consequences of those rules. Yeah.
Dr. Polo, I want to get your insights on this. You are a CIO of a Pan-Asia insurer, right? What are your thoughts on this, right? So on one hand, I think, US dollar capital markets are deeper, so it makes sense to have a larger share of your investments here, perhaps. It's practical and to stay US dollar denominated. But on the other hand, you need to think about your hedging and asset liability responsibilities. It's not an easy balancing act. How do you do it?
It's definitely not easy, and Professor's paper leads me to think that we have to revisit and see how we can optimize our hedging policy, collateral management, right? It is very true that a lot of investable assets are in the US or in US dollars. That has certainly, a long list of reasons, primarily because of the lack of assets in local markets, even though in Hong Kong, right? I think as an insurance CIO in Hong Kong, and many of you have, I'm sure, insurance policies, be it life insurance or savings-related insurance. Many of you have both US dollar policies as well as Hong Kong dollar policies, probably, right? US dollar policies is easier, right? We go buy US dollar assets to hedge our liabilities so that we can deliver our promises to our policyholders. But then in Hong Kong dollar policies, because of the lack of assets in Hong Kong dollars, now this could be, that statement is controversial, but I think it's factual. We, as insurance companies, would need to go abroad to find opportunities of investments. Now, as a prudent insurer, we do have a very robust policy of hedging, right, to ensure that, again, we can meet our liabilities in the currency that we are, we're obligated to meet our policyholders' demand, right? Despite the fact that in Hong Kong there's a peg, right? I think putting the peg aside, we do have a fiduciary duty to ensure proper liability management. Now, the key question that I think worth visiting is collateral management, right? You mentioned about, collateral. So I think we do have different types of collateral management policies, different CSA signed with banks. We can hedge using government securities. I think nowadays we can hedge using corporate securities, corporate bonds as well. But is that sufficient? Is that Loctite? I think that's something that we do need to revisit. But then in the local markets that we operate in, right, we do invest overseas as well. With the, in many of the local Asian markets, there is no peg, right? In Thailand, we do have US dollar assets, right? We have a lot of local Thai government bonds. It will be, I think, an issue to deal with if what you mentioned in your paper happened in places like Thailand, right? If there's a spike, a rally in US dollars, right? And we have to meet with our liabilities and all collateral liability. Very naturally, we would sell our Thai baht government bonds, right? If we do not have any other cash reserves available, right? And that will impact our portfolio value for sure, right? How do we do that? How do we hedge that? And I think the Asian local markets would be more vulnerable from a systematic point of view in the region.
I mean, Dr. Lo's paper talks about the importance of the liquidity pecking order and what having that very clearly in a crisis and how that makes a difference. So what you're mentioning there, things like, it feels like you're doing that as well at FWD. And
yes, as a prudent operator of insurance, right, business, we do need to be very diligent, and we do have a very robust liability and hedging policy from a risk management point of view.
That's great. I want to also mention, if you're online and if you want to put in questions, you can use the chat. We are, covering a lot of ground here with a lot of brains on the stage here. We talked about passive flows, which is a big trend in markets, of course. We talked about various different mega trends like de-dollarization, US exceptionalism. I think the only thing we didn't directly talk about is maybe geopolitics, which is another big thing that's moving markets today. But we did talk about how these other systemic problems can intertwine with fundamentals and change things slightly differently. Just looking at time and also the esteemed audience we have here today as well, perhaps we should open it up to questions. If anyone has questions, I'd be happy to. Yes, please.
Thank you so much for the sharing and the presentation. I do have one very simple question to all the speakers today with professors and the practitioners. It's really asking about the future. So, Professor Liu, you mentioned about there's so much investors hopping to, non-US investor hopping to US assets in the last 15 years. Also, Professor, you talk about the bond market. But this year, last year, and the 2 years ago versus COVID, there's a lot of things changed. There are a lot of wars. The president in the United States, and also there's a lot of central banks withdrawing their money from US and then putting to gold. Just want to ask a very simple question. Going forward, you think there will be more non-US investors going to US, or you see it the other way around in the next 10 years for everybody? Yeah, so thank you.
I guess it's it's a demand supply thing, right? It's not just investor demand; it's also where people want to get their financing, right? So you always have to. I think it's always efficient to have a global reserve currency, right? So that investment and financing can happen in the same currency, right? So we don't have to constantly switching currencies. So I'm a strong believer in a global reserve currency. We had that, British pound before U.S. Spanish. What's that? Spanish. I forgot the word before British pounds. So we always had that. Now. It's true. A lot of the foreign countries, a lot of the foreign central banks are reducing their holdings of U.S. Treasuries in the reserves. That is certainly a trend, and part of the reason is, the U.S. federal government has a pretty big debt problem now, 38 trillion U.S. If you look at, it's interesting. If you look at the convenience yield of U.S. Treasuries, it's not negative. It was, so the U.S. Treasuries were trading, so if hedging out all the currency risk, U.S. Treasuries had a slightly lower yield than comparable German Bundesbond or Japanese bonds. It was about 60, 70 basis points lower in yield, and now it flipped. It's actually a 40, 50 basis points higher than comparable Bundesbonds and Japanese bonds. What that means is, investors are certainly worried about a potential default or inflationary event in the U.S. Now, as for other asset classes, for equity, for credit financing, we need alternatives. for safe assets, I think we can potentially go to gold or digital gold in some form, like Bitcoin or Ethereum. We have some alternative for safe assets for central bank reserves. Now, for other types of financing assets, right, like equity, credit finance, which include corporate bonds, private credit, and so forth, I think it's pretty difficult now. At least at this point, I think it's pretty. It's at least for me, I don't think we're entering a post-U.S. financial system anytime soon. The U.S. dominance is just so overwhelming. It is very difficult to switch to another equilibrium at this point. And I think everybody's trying. We're trying, China's trying, Europe is trying, Japan's trying, UAE is trying, everyone's trying, but it's, having a reserve currency certainly helps. It increases efficiency by, a significant amount. So it always helps. So the way financial market, in the financial market, we have multiple equilibria, right? So the way we jump from one equilibrium to another equilibrium is not a gradual process. It's always a sudden process, right? When the pressure mounts to a certain point, then we see a sudden jump to another equilibrium. So I don't think it's going to happen gradually. Every year, right? We move a little bit away from the U.S. dollar. I think we're not going to see that anytime soon, but at some point this could happen very abruptly.
I think that it's very difficult to change. I think my humble opinion is because simply the fact that U.S. assets offer the best liquidity. You can always liquidate quite easily. You go to Japanese bonds or whatever, although it's quite liquid, it's not as liquid. The bid-offer spread is very, very small, so the liquidity is a big issue. Maybe as a practitioner point of view, talking about Lao's paper is something we find very interesting. As a practitioner, how can you take advantage of your paper? Is the fact that the concentrated selling, the forced selling, happened between 3 to 6 p.m. That is when 4 o'clock is the time when they calculate margin calculation. As that you are a practitioner and you want to take advantage of this, is that you wait, you wait until there's a global financial crisis, and you realize the people being to sell. In case there is a spike up in selling during this period, then this is forced selling. They don't care too much about the price. They wait. The average period is of 7 days or 10 days, so you wait until the 4th or 5th day, and then you buy it around 5 to 6 o'clock at the very low period. Because the paper, actually, if you read in detail, is that there's a reversal. After 1 month, everything is reversed back to normal. This is not fundamental selling. It's just liquidity-driven selling. So when there's liquidity-driven selling, there will be reverse in the future. So in case you want to take advantage of this, you take advantage of spike in yield and gilts in the long-term yield. You buy it later in time when the selling intensifies, and you reverse your position a month thereafter, you may make some money. So it's a very interesting paper. I think it's very, very, although in a ways you seem counterintuitive because it's a reverse flight to quality. You would have thought the fund managers, but I also read from the paper they're basically passive investors. With all the respect to Paul, all insurers are passive investors. They don't care too much, just buy and hold, and therefore do not do active trading. That's the result of this. They do not manage their asset that well in terms of matching their liabilities over the unforeseen spike in foreign currency exposure.
That's great. Thanks for that tip on making a good investment as well. That's always welcome and useful. I myself, just to add to that answer, so I look at equity across Asia Pacific, and what I do think most people would agree is if you go back, let's say, before Trump or before COVID, pick a point and look at it now, look at it then, the volatility in the market, I think, generally has gone up. And also things like headlines, moving markets in an outsized fashion, even just central bank movements, which are important, but it's exogenous of your investment thesis at the stock level, perhaps. And these things creating volatility, or to Dr. Cheung's point, creating an investment opportunity, right? I think these things will probably continue for a while, right? So it's something that, yeah, I think fundamentals and bottom-up work is still very valid, but the volatility in holding a position can be higher than historical levels. Any other questions we have on the line, Lily? Great. Any from the room, please? Yes, please.
Thanks very much, doctors. It's a really great presentation and talk. I learned so much. I have 2 questions. One is when you mentioned earlier that that currently people don't learn that we're still holding so much U.S. assets again and it's surging. Do you foresee that at a certain level of this non-U.S. holding of U.S. assets reaches certain threshold that it may trigger another contagious, maybe systematic financial risk? And the second is I want to learn about your views on central banks accumulating gold as kind of related to this point about shaking up the US dominating system, that there are a lot of sayings about how these banks, they try to accumulate gold so that they're preparing a path in the future they can, get rid of US dollars. So I want to learn about your views on these 2 points. Thank you.
Professor Low, I think this is...
Follow up with Dr. Cheung said. Actually, Bank of England did exactly what you recommended. Bank of England stepped in and then bought a massive amount of gilts in the last in the final days of the COVID crisis, and they made quite a bit of money from that action. So going back to your question, I'll answer the second question first. I think part of the reason that a lot of the central banks are shifting away from U.S. Treasuries to gold. I mean, it's not because they want to kind of get out of the USD system. It's more about they are now deeply worried about the fundamentals of the U.S. economy. they are concerned about because it's now 38 trillion growing. The U.S. government now, the federal government now pays more in interest than in the military spending. So when many countries are deeply concerned about the viability, right, the robustness of the U.S. System, the U.S. financial system. So that's number one. Now, of course, I mean, on the kind of pulling away from the USD system is, I think, on the mind of most of the central bankers around the world. I mean, that's more on sort of the payment system side, right? Everyone's trying to build their own payment system, not just China. Europe has done it, where Russia's done it. Many other countries have tried, or at least trying, to pull away slightly from the USD, the US-dominated payment system. Now, as I said, to pull away from the US-dominated financial system, a financial ecosystem, is, I think, it's very difficult at this point, right? Because US dominates in pretty much every financial market, right? In equity, credit financing, FX transactions, in all the hedging markets. It is very difficult. We need. I think it'll take some time. It'll take some time. If we have couple more Trumps in the next 10, we may have a chance. But it is. I'm not sure if is that recorded. I think. Sorry. What's your first question? What's your first question? I can't remember.
Like when you talk about the non-US holder of the US assets in terms of maybe ratio, does it reach a certain level that it's reflect?
Yeah, I mean that's. I think, as I said, it's an equilibrium outcome, right? Well, the reason there are so many non-US investors are holding US assets is because a lot of firms, households they're looking for financing in dollars, right? It's not just the investor demand; it's also the supply of assets. Right? It's people want to. It kind of stems from the dominance of US dollar based financial system. Because everybody is borrowing in dollar, then you must have lenders in dollars. Because everybody's looking for equity financing in dollar, they must have equity investors in dollar. So it's not a one-sided story. It's kind of both are looking for USD, and then liquidity is the same thing, right? Because financial market is all about expectation, coordination, right? The reason I'm holding USD assets is because everyone else is holding USD assets. Then there's more liquidity in the market. I can easily find a buyer or find a seller. All these mechanisms or forces collectively make USD-based financial systems so attractive.
And that's what reinforces that equilibrium, as you mentioned, right? Yeah. Dr. Cheung, did you have anything to add to that?
Yes, indeed. If your question is about how Professor's paper also touches on actually the policymakers' failings, rather than you hold US dollars hedging instrument. It's because they do not allow the gilts as collaterals. And they have to sell, they have to realize cash, and that's the problem. And also the repo market, because the repo market actually, this interest rate also spike up at the time. Therefore, they cannot use of the repo market at the time for financing, short-term financing. So I think because the insurance, the pension funds try to diversify. And diversification effect has bad outcomes. And it's the failing of the policymakers in the sense that the Basel III, because it's getting very complicated. I don't know whether anyone actually understands the regulations. You read the allowed collaterals; they are so extensive and difficult to understand. Then I don't ever even think that the people who devise the scheme actually understand it in full, and that is making it so complicated. And also because of the failings, they do not actually the hedge funds and the dealer banks are the person who absorb the selling. and they do have enough capital to absorb the selling. Therefore, there was a drop something like 50 basis points with a matter of 7 days. 0.5%. It's a lot in terms of long-term yield. And it causes instability within the system. So the fact that you want to stabilize the system by using collaterals actually becomes the agent for this destabilization. And that's the major issue, I think.
As I mentioned earlier, I think in current CSAs with financial institutions, government bonds like U.S. Treasuries, and to a certain extent, depending on the counterparty and the quality of or the rating of the bonds, corporate bonds are actually allowed as collaterals. So that may help mitigate to a certain extent the issue. Yeah.
I think we may have time for maybe one last question. Yes.
Hi, I'm Lawrence. It seems that the questions on the reserve currency has been a hot topic. So with due respect to the finance department, maybe that question should be posed to the political science department because it's political issues apparently, right? So if with that in mind, obviously, if that really happens, from the finance department, what do you think we should do? Where we should revert to real assets, physical assets, companies with cash flows, and then we probably back to a different currency unit. I mean, I don't know, something that we should dream of when we cannot go to sleep, and what we should do. Thank you.
I think it's both a political science question and an economic. It's also an economic question. I said, I'm a strong believer in having a reserve currency. It increases. It's a public good, right? It's a public good. I mean, the U.S. is providing that public good to the world. Of course, it enjoys a lot of benefits from providing that public good. I think so. So I think there always will be a reserve currency, and I doubt it's going to be, it's going to be a basket of currencies, or it's going to be a cryptocurrency. And the reason is, I think cryptocurrency could be something like gold. It's going to play a similar role to gold. I don't think it's going to replace USD as the global reserve currency. And the reason is, in order to be the reserve currency, you want sort of, firms, households to be able to both finance and invest in that currency, right? It's not just for payments. Payment is just one part of a very big picture, right? Payment is actually, it's not even the most important part of the financial system. It is a significant part of the financial system, but it's not the entire financial system. There's investment part and there's the financing part. I'll give you one example. So, so China, it's fine if it's recorded. So China, so we signed an agreement with Iraq back in 2022, where we're going to buy, where we said, we're going to buy oil from Iraq with RMB, CNH, the global RMB. And Iraq pulled out of that agreement after about a year, less than a year actually. Now the reason is the Iraqi government quickly realized that there's not much use of RMB, right? Because they don't have, because they need kind of a deep, robust financial market, right, to deploy the RMB. Right? You need to give me instruments for cash management purposes, right? If I want to buy, let's say buy equipment in 3 months' time, right? I need to be able to, save, right, in treasuries for a short period of time to earn a little bit of interest. In the longer term, I want to be able to invest in equity market, right, to earn a reasonable return. I also want to be able to do, trade financing, all those things, right? So, and this is why it is so difficult for us to promote RMB globally, because we need kind of a whole financial ecosystem to support the currency. It's payment just a very small part of it. We can certainly ask our trading partners to accept RMB, but then once they get RMB, they have to use it somewhere, right? And we have to give them the investment opportunities. And there are multiple layers of investments they have to do, right? There's short-term cash management, medium-term, credit financing, loan lending market, and then the long-term equity investment. And this is why, I think a single currency helps in that regard, right? If you have a basket of currencies as reserve currency, it's hard to imagine that we're going to have an equity market that's denominated in 50% RMB, 50% USD, right? I mean, it's going to be equity market, bond markets. All these markets are going to be denominated in a single currency. So I think it's going to be. My view is, we're still going to have a global reserve currency. For the near future, I think it's still going to be the USD, because the system is so robust and sophisticated at this point. But maybe in the longer term, there will be kind of a reflection point where we see a sudden move to another equilibrium. That's possible. Okay. And again, like if we get lucky, if we have a few more terms of.
Thank you very much for. I think we're at time. That was like so exciting and interesting. I think thank you for joining us, everyone, today. The two excellent papers that we covered explain what's actually moving trillions in our system. And we had expert perspectives from both academia and practice on how they're using research as a powerful detective tool in their actual work and to navigate markets. And together, we hope this Business Talk Today session inspired you to have a deeper understanding on the invisible mechanics that dictate global capital flows. I want to say thank you to our authors and our panelists. I wish everyone a productive afternoon, and I'll pass it back to Lily.
Thank you, David. Very engaging discussion, and I'm so proud to see our DBA alumni engaging in such a stimulating conversation with our professors.